All right, we are here for our bi-weekly deal decoder where we talk about legal transactions that are relevant for you and educate you about these transactions to help you be proactive whenever you're trying to set them up. And we're streaming here live from Geekdom, and a conversation I have regularly is with people that are raising capital. I'm going to take a second just to make a plug here. We are going to be doing a raising capital boot camp in the beginning of June. It's a 6-day event, not all 6 days. It's not full 6 days. It's 1 hour virtually for six different modules that we're going to do. But we're going to be working through the beginning to end on raising capital, getting your house in order for it. What do you need to know with regard to how to structure the deal, different types of deals that can be structured. And so, if this is something that's of interest to you, what we're about to talk about today, and you would want to learn more, be on the lookout, because in the next week, we're going to be announcing this boot camp that I think is really going to help educate startup founders in a way that can help them make better deals earlier on and avoid some of the pitfalls that we have to clean up here at the South Texas Business Lawyers. Today, what we're going to do is we're going to talk through a term sheet. And most of the time when we do this, we talk about documents that we have as part of our membership program and go through a model document. Today, I want to introduce you to a resource that's actually available for you right now. And it's a tool that I'm going to endorse, to be honest with you, because I think it is very, very, very well done. And really, this comes through a book. And you can see on our screen here, it's about to be Venture Deals. Venture Deals is a book by Brad Feld and Jason Mendelson. And it says here, be smarter than your lawyer and venture capitalist. Well, I didn't find that it was smarter than me, but I did find that it was a great resource to help those that are engaged in either early stage investing or early stage founders, to help them understand the process with regard to venture capital, which is just a very sophisticated process for raising capital, whether you're doing it with a third party or a VC firm. This book, we usually have it here on the shelf. It's actually at my house. Is a great resource. I highly recommend it to those that are investing or growing early stage companies, because it goes from cover to cover on what it takes to get a good deal for a founder, and then helps investors understand the founder's perspective of what they're trying to get. And so, as part of this book, they have one of the great things they have as part of their website, and it's venturedeals.com, is their resources tab. And you can see here, they've got some great standard documents from the Foundry Group that you can use. Now, I will tell you, I'm not going to endorse their stock purchase agreement or their investor rights agreement. I think they're good resources, but a Series A term sheet, or a term sheet that is non-binding in nature, is something that can save you time. It can save you some money, and it can also provide a guide for you as you're going to go through and negotiate what is good for your company that's out there. So what we're going to be doing today is actually looking at their proposed term sheet. And it's got a whole lot of bells and whistles in it, which is great. You may not need them all for your transaction, but we're going to go through this together pretty quickly, so that way you can understand the nuts and bolts of a term sheet. At the highest level, a term sheet is what is getting together all of the fundamental negotiated issues in order to issue stock to an investor. Okay. In this context, it's a venture capital, so it's a very structured deal, but you're going to usually put together a term sheet to make sure that the business terms between the company and the investor are agreed upon before paperwork starts to be putting back together. And those business terms usually are around the amount of the investment, the terms of the investment, meaning how much stock are they getting? Is it a convertible note? Is it a safe note? What is the structure of that transaction? And then there are also things that come in with regard to corporate governance and other sort of protective rights that could be a part of the document as well. And so there is some big buckets that you're going to go through, and this document does a great job to go into detail to give you a guide of what each of the components for those big buckets are. Looking here at the investment term sheet that we have here, this one looks to be that you're going to be looking at the amount of financing that's going to be coming through on here. Now, this is a very, very complex document, and we're not going to go into all the complexity because the amount of financing is based upon a post close ownership stake and has to attribute to account certain other conditions like an employee pool and others. The complexity of that we're not going to get into, but at the end of the day, you're going to be putting in what am I getting for, or what are we giving to this investor? There's two different ways you could look at it. You could look at a pre valuation ownership percent stake or a post close ownership stake. And we'll talk in our boot camp about the differences of those, but usually that's laid out in here as well. The rest of this, as you can see, is pretty straightforward. Who are the investors? When is the closing? What takes place after a term sheet is then the definitive agreements. It could be a stock purchase agreement. It could be a convertible note. It could be a safe note. Again, these are things we'll talk about in our boot camp. But the closing is a future date. This memorializes the business terms for the lawyers to put together the definitive agreements in order for the actual investment to occur. And we want to put some sort of date with regard to when we're going to close this transaction. Sometimes there could be multiple closings that come through. For example, you could have a lead investor that's coming in with, let's say, 50, 60, 70% of the funds that you need. And then there could be subsequent closings for additional investors that are contemplated from this fundraising round that could come in as well. And again, that's where the closing could come in. Price and valuation. This is where this is a direct issuance that's going on here. And so the price, the valuation of the company based upon the price, pre-money, post-money. This talks about fully diluted pre-money valuation and the post-money valuation here. These are things that, again, are business terms that are usually negotiated and worked through from a financial standpoint and put on there. For this type of security, we're looking at a Series A preferred stock. It could be a pre-seed preferred stock. Just, a quick side note here. You don't have to do this in the exact order that most founders think. What do I mean by that? Most people think I can only raise one round that's a pre-seed. Then I have to do a Series A round. Then I have to do a Series B round. You don't necessarily. I have clients that have done multiple pre-seed rounds. Series A rounds are usually signals to the venture market with regard to where you are in your commercialization and your development process that are on there. I have some clients that have had a Series A-1, a Series A-2 to not move into the B round because of what that industry of B round indicates to venture backed companies. It just depends. It depends upon your governance structure. It depends upon your investors on how they want to move forward on that with regard to the labels. Here it's a Series A preferred stock that are out there. The founders that are put in here, you can see that usually there's some details with regard to founders. And then this is the first big concept with regard to the board of governors. And the board of governors, again, this is usually, especially in a Series A round, sometimes in a pre-seed round, is a very, very big point because money is coming in from a venture-backed organization or from a venture fund, and they're going to want to have not only money in, but a say at the table for the direction of the company through the seats of the board of governors. And if you come to the boot camp, we'll talk about governance structures and how to negotiate those. But this is something that is the amount of money, the price per share, the percentage I'm getting for that, and the governance you can see is on the first page here. Because these are the big bucket items that we have to make sure that we've got. Now, if you look through all of this, you can see that this is a binding, non-binding term sheet. And you're like, what does that mean? Well, non-binding means that everything on here is non-binding. And it means that at the end of the day, nobody can sue anybody for a breach of contract. There are certain things, though, when we are putting together a term sheet that we want to be non-binding. For example, all right, well, there's some diligence that has to be done. We've had a handshake deal that we want to figure out how to have this sort of investment in board of governance, but there's still time before we get to the closing. We want to have the ability to walk away if it just doesn't work for whatever reason. So those are non-binding terms. But then there are certain terms you want to have as binding. Confidentiality. for the fact that we're talking together and those sort of things. That is something you want binding. If we made it all non-binding and said, hey, you have to keep this confidential, you really don't have to keep it confidential. It's non-binding. So this is a non-binding, binding letter of intent, and you can see that there are certain provisions here that are referenced in the quotation marks that are going to be binding going forward. And these are very, very typical that we have. And then we have the signature. The terms and conditions and the way they structure this term sheet, sometimes we put it all before the signature. Sometimes it goes into, an exhibit or the terms and conditions. This is where we start to get into the nuts and bolts of these buckets that we talked about at the beginning. So capitalization is where we have to make sure we talk about is these terms that we have of diluted and fully diluted. What does that mean? Because there could be outstanding options, there could be restricted stock that's out there, a whole host of safe notes that could be out there. They're going to be converted, convertible debt. So everybody wants to make sure when we talk about the percentage, what does that mean with regard to all of the equity or convertible equity? What does that mean for the cap table there? Dividends. Many times when we have a venture backed investor, but I will tell you over half the time when I have third parties coming into deals that are not even venture backed, we have some sort of preferred distribution for the preferred shareholders. And this is where we have an 8% non cumulative dividend preference when declared by the board of directors. These are where stockholders that are coming in as preferred stock can have these Series A preferred stockholders have a different way that they receive dividends. They're preferred 8% on this example versus what the common stockholders get. Common stockholders don't get that additional 8%. They only get regular dividends that are out there. And see, you can see through all of this, and again, this is a high level discussion, and I got a example for you that's very detailed, which is great. And read the book because they go through all of this. Come to the boot camp because we're going to go through all of these type of concepts. You can see that these Series A preferred stockholders, they're going to be treated different. They're going to be treated different when declared by the dividends. They're going to have different liquidation preferences, which means if the company has to dissolve or is sold and by the assets are sold and we're going to liquidate it, how does a Series A holder get treated differently than a common stockholder? If you're doing a Series B round, Series B could be treated different than Series A, who is treated different than common stockholders, or they could be treated Series A and Series B the same, but still different than common stockholders. These liquidation preferences, these designations that we have here, these are going to be documents that are memorialized in the company's certificate of incorporation, in the shareholders agreements, in the bylaws that are out here for all of these terms. But we start to put them down here with regard to how is a series holder treated, a holder treated different. Conversions that can occur where what happens if the Series A holders, which have an option to convert their Series A into common stock, how is it? And I would tell you, these things may seem like they're not important. Let's just get it done. But if you don't get these provisions to be market on what the venture community thinks is acceptable, then you can find yourself in a really hard position. Let me give you a quick example. I have a client that has liquidation preferences and conversions where the preferred stockholders get a 3-to-1. Well, what does that mean? Well, it means essentially in certain situations, if that preferred stockholder or the preferred stockholders have 30% of the company, they can actually dilute the company down where they're 3 times the size of that, which could be, upwards of between 60 and 90% of the entire company goes to a preferred stockholder, which effectively makes the common stockholder where they are, have no power. In certain circumstances, we have to look at the fully diluted, which means if all of the options get exercised, fully converted, which means if everybody has conversion rights, we convert them into that. And then we look at the cap table, which could be very different than what your cap table looks at today that just says who's been issued stock, common stock, and preferred stock. That capitalization section that was pretty complex, that's what it talks about is what is diluted, converted. What does that mean? Because on a fully diluted, fully converted basis, founders could think that they own 60 to 70% of the company on the regular cap table, but find on that fully diluted, fully converted cap table, they've got not much at all. And that's a big deal. That's a big deal for future investors that are coming in. That's a big deal with regard to how you deal with, issues for the company at some point in time. So again, pay attention to these. There's a lot here. I mean, again, this is a 9-page term sheet, and it may not be applicable to you, but the details of this, if they are something you're discussing with your investors, are critical that you get them right and that they're what the market expects, or you could find yourself in a really, really hard place. Anti-dilution provisions that are out there talk about, well, what happens if new issuances are made? As a preferred stockholder, do I get to buy my pro rata share to protect myself from dilution that's out there? Is there certain things that the company can do that is where they're allowed to issue new or to take on convertible debt, and I don't have any sort of protective rights? Voting rights, again, do I get to vote differently than anybody else? I have clients where the Series A stockholders have all the voting rights. The common stockholders have zero voting rights. They're actually Series B stockholders. There's only A and B in that company. B have no voting rights. A has all the voting rights. That's where this comes into play of what that looks like. And sometimes I'm here with the board observer. Sometimes the governance negotiation, which is another critical negotiation, the boot camp, this book, great resources. You need to make sure you know, because you could lose control of your company very fast. As part of that negotiation for certain large investors, we won't let them on the governance because of the fact that now we could lose control or it's just going to make it too complex. But they still want to be able to participate as a board observer. And so a board observer is a person that is allowed to come to the general meetings of the board, usually, and they are allowed to listen. Many times they're allowed to discuss. They are not allowed to vote. They're just an observer. In many circumstances, if there is an executive committee or a closed session that is called by the chairperson or the CEO, sometimes can do that, then the board observers are excused. Or if counsel comes in and says, hey, this is a sensitive subject with third parties, the board just needs to meet. So there are some limitations of how much they can participate, but they can't vote. That's the biggest thing. So from a corporate control and governance standpoint, you can be protected on that one. Some other protective data provisions that are in here. Again, book is great. Boot camp is great. Not going to go through there, but there are other ways that we go through it. Information rights for shareholders of a corporation or even members of an LLC, which again, even from an LLC standpoint, if we do preferred class holders, membership unit holders, we do the same thing just in an LLC format versus a corporation. There is a very structured what a shareholder or a member of an LLC, the entitled information that they have. LLCs can actually get more in Texas than a shareholder can. They just can't walk in and say, all right, I want all your financial records. Let me see your audited statements. I'm a shareholder. Show me. You can't go necessarily down to Apple to do it. Now, they're a public company, so they have a lot of things they have to post. But in the private context, there is very limited information as an owner you can get. You can get some, but you can't get all. Well, significant investors may say, no, I need to be beyond what I'm entitled to as a shareholder. I want better information rights where I want to receive all of the monthly financial statements, which is the example here. I want to see all audited statements that are there, which in a private transaction you wouldn't be able to see, or excuse me, a private company you wouldn't be able to see. Public companies we can see that stuff, but private ones we can't. This is where we detail those. And again, you want to make sure you structure it in the right way, because you want to make sure that the company is not getting itself into trouble with regard to selective disclosure sometimes, or putting it at risk with what this is. Looking at monthly financial statements, budgets, unaudited quarterly, audited annuals, those are fine things. But be careful of what certain investors request or demand that they get as part of their ownership that are in there. Registration rights, these are pretty typical. I'm going to skip this whole thing. This basically happens as to what if some other investment takes place, or when you're going to be forced to go public and register your securities in the United States. The general rule is that unless there is an exemption that applies, every sale of a security must be registered in some form or fashion. That's kind of the general easy rule to remember. Well, we do have things like Reg FD that allow us Reg D, where we can do certain exemptions to not have to register those securities. But sometimes the negotiation says, okay, if the company decides to register, or in these situations you must register, that's negotiated as well as part of it. Right of first refusal, you can kind of see there too. That's kind of somewhat like the anti dilution stuff that's out there. So again, lots of governance and preferences topics that may be relevant to the investment that's there. The details of that we're really not going into. That book here, which we've been talking about the entire time, which is Venture Deals, is a great resource for you to look at. I don't know why it's not loading, but oh well. Next thing you can go into is employee matters. And this is where, in a lot of pre seed rounds, even Series A rounds that are, I would say, pre Series A, but you want to call them Series A, these are things that may not actually make it into that portion. But true Series A rounds, or more mature investments where you already have employee pools that exist, become relevant, because with money that is coming in, part of that they may want to have where the founders have to give up some of their equity to push towards the employees, because the new investors want to ensure that the employees have skin in the game and are able to be rewarded as this company grows. And so the employee matters talks about the employee pool that would be set up, how that vesting would occur, the restrictions on sale with regarding the incentive stock plan that would be set up, and those sort of things like co-sale agreements, voting agreements, and then also what would happen to the founders as well. This is something that is an employee matter, but I will tell you, regardless of what you're doing, you should be very, very cognizant, because it's something that sophisticated investors are going to look for, and it usually is a deal breaker. But for the companies they really, really want, they'll help you fix it, and that is proprietary information and inventions agreements. If you are, especially in the tech world, where you have intellectual property that needs to be protected, it is super important that you have in the proper agreements with all of the people that are a part of your development and a part of your company, to ensure that it is crystal clear that the ownership of all intellectual property is the company itself. So, for example, if you are using outside software development companies, making sure that it is crystal clear that what is being developed by that software development company is ownership of the company. Be aware of licenses or co-licenses for developed work product and improvement of tools that can muddy that and cause real concern for your investors, or even an acquirer. And we do lots of M&A here, and so we've had to deal with that a lot. Make sure that all of your employees have inventions and assignment agreements, and that it's clear that they've signed those, that says that this is owned, anything they do is owned by the company. Confidentiality agreements, so that way they can't use that anywhere else, is signed by all employees. Anybody that did things prior to the formation of the company has assigned that intellectual property into the company, which we usually do at the same time of issuing the founder stock. But if you've kind of done this, ad hoc and trying to get things going, which a lot of clients are do, you may have skipped that step. We do that when we are with companies from the beginning out there. This is something that's critical. You see it on the term sheet, because they're saying you've got to fix this. And a lot of times it's something to be fixed. And then we come to the other matters that are here with regard to, when's the closing going to happen? What has to occur in order for the closing to happen? What gets delivered at closing for those? And again, the details of that, like for example, you have to get an opinion of counsel for the company. These are highly negotiated. Get an opinion dependent upon the actual terms of that opinion, and those opinions can cost you, 20, 30, $40,000. So you got to be careful at even some of this boilerplate to understand the cost of what you're dealing with. And again, a lot of this other matters here, you can read through. Part of the other matters contains some of the binding portions of this. The non-binding was what we just talked about, which was what are the preferences, what's the financial terms of the investment, even the employee matters. Those are non-binding. But things like a no shop provision, where the company is saying that they are going to not actually solicit or deal with any third parties, that's a binding portion. So this is what again makes it a non-binding binding letter of intent. And you have to be careful with that because this one here locks you up for 60 days. And at the same time, if you're in, where you need this money and you have to go all in with one person, which they may want you to, and it could make sense, but just know, like, you can't go out and find, somebody else if you don't start to like the deal that's out there. And a lot of times, if somebody reaches out to you, you have to hand that to your current investors. But a no shop agreement kind of locks you in into what you're dealing with them, and that could make sense. It could not make sense, for that. So be careful of what the binding provisions that are out there. And so, you can see here as we go through it all, it's not, I mean, it's 9 pages, but the concepts that are out here is where we're memorializing these business terms of what it means for us to do this deal. If you're an investor that's investing in, you want to make sure that it's really clear what you are putting your money in for. That capitalization part for everybody. But if you're an investor that's investing in this, making sure that you understand, hey, I want to have 10% of the company on a fully diluted, fully converted basis. That is a crystal clear, as long as we define what fully diluted, fully converted is, of what you end up with when you put your money in. For the company, you want to make sure it's not just your stock register and looking at necessarily for your cap table. If we have things like fully diluted, fully converted, you have to go look at securities that are convertible into equity. You have to go look at, conversion rates that are out there that could actually dilute what that cap table looks like, to really understand what's your true capitalization when it comes to the financial aspect of this. And so these terms are really, really important. So, for these, I would tell you again, I'm going to go back to Venture Deals as a great book. It's a great resource. I usually have it on my shelf again, but it's at the house because it helps, I think, get you to understand from the founder and from the investor's view what each of those concepts means, because they're critical to understanding and negotiating it. For those that want some more hands-on training, we are going to be announcing in the next week our Raising Capital Boot Camp. It's a 6 day event. It's basically 1.5 hours we do virtually for 6 days over 2 weeks. We're going to be having some guests join us to talk about their perspective, some venture capitalists that'll join us, some that are founders that have dealt with this that'll join us to talk about some practical issues. But we're going to walk through all these concepts together so that way you can better understand and be prepared to negotiate. Because many times people just know, I need money. And then they say, okay, what do I need to ask a founder? Let me find a term sheet and I'll go off of that, which we just went through one. And then they go, okay, I need $1 million and I just want to give up 20% of my company. Let me negotiate with somebody and ask them for a term sheet. Well, that's the wrong way to approach it. The right way to approach it is, we know the money we need. We know the type of investor we want from a strategic standpoint. We know how we want to negotiate the structure of the transaction, from capitalization, from governance, from all the other information rights, employee matters, if we have to deal with those, because all of those pieces make the difference for this company. And if you make the wrong choice early on, like I told you, I had a client that had a conversion of 3-to-1 with one of their major shareholders. It just changes everything for everybody into the future, because third parties coming in and seeing the deal you did at the time to get that money that you thought was your number one priority, realize they're not going to invest in you because of the fact that it's just too risky and they would be diluted out. Or when they put their investment in and you do the fully diluted, fully converted, you realize that new money just effectively diluted you out completely because you did the wrong terms early on in a pre-seed or a Series A. So hopefully this has helped you. We usually do this in our private Facebook group today because we're using the Venture Deals documents, kind of talking generally, not our own. We decided we would do it out there. For those of you that are maybe new to us, we are the South Texas Business Lawyers, and our mission is to educate, support, and advise every startup and small business, small, medium-sized business in the state of Texas. And we do these about every 2 weeks, going through deals, doing the education, so that way you can be proactive. We want you to be a better, more informed founder so that way we can help you accomplish your goals when these transactions arise. I hope everybody has a great Thursday. Watch out for the weather and check us out again as we start talking about our Raising Capital Boot Camp. You don't want to miss it. See you later.